first day. We're going to make sure there's plenty of breaks in between and plenty of rest stops too, because it's all a bit much just sitting there for all this time and getting all this information. So we have plenty of breaks. So we're going to start off with the first section, which we'll be going into very soon. Will be based around an introduction to angel investing. So it's kind of more around what does angel investing look like? Why do angels invest? What does the industry, the ecosystem, the investment and the funding landscape for a startup business look like? And what are the different sources of funding out there and how do they work? So it's kind of trying to give you a bit of a better feel as an introductory piece as to where Angel sits in the world, why you would want to do it, and some of the numbers, the core numbers behind angel investing. So that's kind of section one. We'll probably do a break. We'll be kicking that off in about 3 or 4 minutes. We're running a bit ahead of time, which is nice. And that will hopefully we'll have a short break after that. It'll be about an hour's long, roughly. The next section, which Andy is actually going to be leading, is around developing your thesis. Andy, what do you want to cover? A quick overview of what's covering in that area?
Yeah, sure. Developing your thesis is something I think that we hear a lot about in venture capital, but not so much about in angel investing. But it's really important to just recognize that even though we're here together on this course, it's a very individual and personal journey, right? And only you know what you're really interested in. You know, there could be a certain area like biotech that really gets you going because you studied biology at university, or another area like fintech that is really exciting for you. And the key to this section is we're going to really talk through how to create a clear and concise thesis that's personal to you, and then how to actually use that to help influence and guide you and filter when deciding on the right deal to pick, which is the next section following that.
Awesome. So then we're going to go into how do you pick the right deal? I mean, it's obviously people have different beliefs and different interests in different areas, but what we want to really give you guys is a really strong understanding of what does good look like. And it's not just about what does a good business look like, it's fundamentally what does a good investment opportunity for an early stage angel look like? Because some companies might do really well, but actually not really give you that good a return. So it's about looking at what does a good deal look like? What should you be looking for from an angel perspective? And it should give you actually a pretty good grounding as to kind of what you should be keeping an eye out for as well. And then the final part, we're going to see some live pitches. So I've got, and these are all actually, they're actively fundraising, or they might have closed, but they'll take more money anyway. I said we're going to see 4 businesses, all from the UK. So again, apologies, they are UK based. But I want to give you just, we're going to watch them. We've got 4 companies doing 5-minute pitches. And we're going to watch it all together, and we can make some comments and chat about it. I mean, ideally, we'd like to kind of, I think there's too many of you to do some breakout rooms and talk about it in more detail, but I think what could be really interesting is if you put comments in the chat on the Q&A, things that you notice that you like, that you don't like. Andy and I will probably do a bit of commentary as we go through a little bit and say things that as we see them pitch and say that's really interesting, or what they just said, that worries me a little bit. I'd be really interested to find out about that. Because a lot of the time when you're trying to engage or find new startups, it's a bit of a process. You'll see something, only a light touch bit of information at the point of it. So it might be the pitch, it might be a slide deck, or something really, it might just be a little elevator pitch that explains the business. And you want to, comes down and touches on the importance of Andy's kind of investment thesis. We're time strapped, we're time poor. There's a lot of deals out there. And you need to be able to quickly go through and see what's interesting, what's not, what's an alarm bell, move on to the next one. Is it within my thesis? Is it not? If it's not, maybe help them out, introduce it to someone else, or just move on and look for something else. So it's all about being as efficient as you can, but also just seeing some pitches in action and to seeing some of the things that I think when I see them as well. So they are all actually, all 4 of them are pretty good. So they I wanted to find a bit of a duff one to show you all as well, but they're actually all in pretty good shape as well.
Yeah, and I think the key thing there is, especially with what Rod is describing here, at first we're always going to take time to review pitches, right? It's your first time, it's the first few times of doing it, but after a while, especially as you start to build a portfolio and you have 10 startups or 20 that you're looking after your portfolio, you suddenly become a lot more efficient because you get a lot more used to it. It becomes more like muscle memory, but also you've got less capacity, right? So you really want to filter through your nose and just focus on the yeses.
Cool. Angel is someone who actually can provide some level of support, guidance and help to that business in their journey. And we will cover tomorrow, we'll cover a lot more around the sorts of ways that you can really help them. And it might be ways you hadn't considered before that can really support businesses. Fundamentally, they're often regarded as being ultra high net worth, or sophisticated investors. Now that is for a very good reason. And it's because this is a high risk game. You know, you need to be able to invest in quite a number of businesses, and I'll get onto that in a bit, to make some returns. It's because it's high risk and you might lose everything, not just some, you might lose everything that you put into it. It's only recommended that you're investing between 10 to 20% of your overall portfolio goes into angel investing. And so also because of legal costs and the complications of putting money into a business, often the kind of minimum investment that people tend to make is around £5,000, probably, what's that, 20-25 reals. It kind of means that to be investing in a lot of businesses, at least £5,000 a time, and also putting in, and also only it being, a percentage of your overall portfolio means that you should have, a reasonable bit of asset, a bit of money behind you to do this. It has shifted the industry, and you can feel free to jump in a little bit around how people with less money can now deploy via crowdfunding platforms and put smaller amounts in, but it isn't for the faint-hearted, and you should have should never risk more than you can afford to lose is the golden point, to be honest.
Absolutely. I think I'll just echo that. Like Rod said during the introduction, like the rare opportunity with being an angel investor, unlike public stock investing, is that you get to be hands-on and really supporting the management team. And you're paying for that privilege to learn alongside them and to be able to support them. So at minimum, that's what you can get, and we'll touch on returns a little bit later, but it's just important to really have the right mindset when going into this opportunity and getting started as a business angel. We'll touch a little bit more around the mindset and things to really think about on that journey too when getting started.
Yeah, absolutely. So I want to cover now a little bit about why do angels invest? Why do they do it? What is the point? Why do they get involved and get excited about it? Well, it's pretty, there are a number of reasons, and it's not all as straightforward as you might think. Reason number one is it's fun and exciting. It is a fun thing to do. It is exciting. You're backing the latest technologies, the next generation of founders. It's starting a business is hair raising. It's interesting. It's hard work often, and you're being a small part of that journey by supporting those founders. And so it is actually fun, and it is an exciting thing to get involved in. And obviously, it's a high risk investment asset class. And so there's a bit of excitement attached to that. How well will it do? Is the company going to pay off? Is it going to grow? Is it scaling? And it's really nice to be a part of those really interesting journeys as an investor. There's lots of investors that we work with and know, they do this pretty much full time, and they do it as pretty much 100% of their asset allocation. They put it into this because they love it. And it's one of the reasons why our stats also state that like 80% of the angel returns I mentioned earlier go back into angel investing because people love it. It's really fun and exciting, and you can do it with friends, you can do it with and have a good time in doing it. So that's the kind of the big point number one. It is about enjoying the journey, and we want to make sure, and hopefully through education in this course, we'll help you worry less about the risk and more about enjoying yourself and actually enjoying the process. The second part, and a really important part to bring into this, is that kind of altruism aspect. It is altruistic. Now, by that I mean, by investing in early stage businesses, you're giving back in actually quite a lot of ways. So first of all, by investing in an early stage business, you're investing in the next generation of technology, the next generation of founders and entrepreneurs. You're giving someone who has a passion and an idea a chance to help make that passion, make that idea a reality. In them doing, hopefully they're solving some kind of world problem. It might be a business problem, it might be something less interesting, but they're making a difference out there. Also, in that person, that individual that you've invested in, with them starting a business, they are growing that business. They'll be employing people locally. They'll be buying services locally. They'll be giving back to their local community, be buying offices, paying rents and rent, whatever it is they have to do. They'll be giving back to the community, that business, in its own growth journey, which I think is really important too. And I think third of all, the kind of key part around the altruism, is that you can invest in sectors that make a material difference to our world. And that to me is really important. You can invest in life sciences, green technologies. You can invest in financial services inclusion. You can invest in businesses that can help the world. Not only help your local businesses, your local community by giving money into the system, by helping to form a business, investing in the next generation of technology to help make the world a better place, but in sectors that make a meaningful difference to society. And in fact, some of the most successful, profitable, and enjoyable and popular sectors in the UK are life sciences and healthcare. Also, notably, a massive uptake in green technology. You think with the pandemic, everyone's a bit cost constrained, they're stressed, and actually rather than just thinking about life sciences, ed tech, how do we get our world back together again, they're thinking very profitable to angel invest. If you're careful and you follow some of the strategies that we cover and there's a bit of luck involved, it can make really good, solid returns that track really well. And we've got quite a lot of information, quite a lot of data, which kind of backs up some of the returns that can be had. And also, I've been working an awful lot alongside a lot of lead angels who do a lot of investing myself, and can make some really good, healthy, good returns across the board, which actually massively outstrip other asset classes. Andy, do you want to add anything about why investing at this kind of early stage? Why do you get involved in it?
Yeah, absolutely. I think just to supplement what Roger shared, like the key thing in the title is why, right? And really understanding your why. And Simon Sinek, the author, wrote a famous book called Start With Why. And that motive is really important because that's going to be a driving factor to kind of keep you going along that journey, even when sometimes the investments aren't working out as you thought they would. And in terms of some other reasons to consider, like some people like that I've met have just loved being around the cutting edge of technology, right? Because some of these entrepreneurs are working on cutting edge technology in fascinating ways that, you wouldn't even imagine or think about, right? Another thing is like it's part of a diversified portfolio of assets, sometimes even across asset class. So some of you may have property portfolio, you may even have your own businesses yourself or some public stocks. But actually, this is a good part of that diversified portfolio. And we're going to talk a little bit later about how to even diversify within this asset class alone. One of the other reasons for some people is simply that, you could be retired, right? So you've left work, you actually have ample time and capacity and a great networking skill set, and you want to put it to work alongside your capital, right? And some people such as Rod and I just love and enjoy supporting entrepreneurs. Like we get our kick out of it. We thoroughly enjoy it, and for some of you, I guess in this group, like the ambition could be like to learn this, start investing so that you can start your own angel group, right? You might start a syndicate, you might even grow to start a VC firm. So, these are all the like supplementary reasons why you might want to get started. So really drill in and have a reflection on kind of why you want to get started. And I'd even love to hear from some of you in the chat, or even unmute yourself to share some of the reasons why you were interested in getting started and even taking this course today.
Awesome. So look, we're going to kick off with I think covering a few of the biggest misconceptions as well. I'm gonna let's have a chat about this, Andy. First of all, it's not about unicorn. Unicorns are rare. That's why they're called unicorns. There's only a handful of them as well, and it's not necessarily about investing in a unicorn that gets you great returns. It's about investing in really good scalable businesses. Our exit of the year last year for UKBA, we have our big awards every year, was a company called Ziyara out in Bristol. They exited for £650 million. That's not a unicorn, it's sub-unicorn because it's not £1 billion. They exited for 650 million, so they're not a unicorn, but they achieved that valuation within about 4 years. And the angels at the beginning, at the outset, probably received a 200-time return, massive return on investment, a huge return in a very short time. It's not all about unicorns. It's about great, solid businesses that can grow, scale, and get an exit as well. And that exit typically isn't just generally, I'll get into that, isn't necessarily an IPO. So it's more about companies that can trade, sell, and get good returns and turn that over. Also, Andy, you want to cover a bit about, it's not really investing in friends. There are friends and family rounds, and they are important, but actually this is taking this as a bit of a professional approach to this and investing Absolutely. And looking at this. And if you get strong armed by a nephew or someone to put some money into it, then it might not be the best deal. It might not be a good business. You got to make sure you have your business head on it as well. Do you want to add anything to it, Andy?
Yeah, I could. Firstly, with the unicorns, I think what Rod has shared is really important, because we're not talking about being a venture capitalist here. We're talking about being an angel investor. And therefore, the multiples required to make a good exit are actually different to that of a VC, you know, who invest other people's money, essentially. And on investing in friends, I'd love to share a bit of a war story, a personal story myself. And I think about five or 6 years ago, a friend of mine shared a deal with me for an early stage startup that was an engineering startup that worked across Central Africa in Cameroon. And their core product and IP was based.
Right, welcome back, everyone. It's been over 15 minutes. I gave you, I think, 17 or 18 minutes because we're very generous here. Andy's back as well. I'm going to make sure, give you a bit of time just to switch on, you know, put the volume back up and everything else. Make sure you're all muted and get yourself sorted as you come back. And then we're going to kick off again. Did anyone have any questions at the end of that section? Can we close it a little bit quickly? We're running about 15 minutes behind the kind of agenda schedule, but to be honest, I think we can probably save that time up as well by being a bit quicker in a few areas as well. We're not going to shorten any comfort breaks, that's for sure, because I think it's nice to have these rest periods anyway. Some comments I've seen here from Mohammed. I like the idea of a group of angel investors. It makes it better to take a decision and share thoughts. Couldn't agree more. And there's actually more benefits around that, which I will cover. The first step, proposal to call investors angels, this is the most important action in your journey. So how and where? The first step for proposal to call the investors angels. This is the most. I don't quite get the question from Adnan. You've asked the first step for proposal to call the investors angels. This is the most important action in your journey. So how and where? Can you rephrase that, Adnan? It might be a bit of a language barrier there. So if you want to maybe post that in, we can get that, can be maybe translated as well. I'm not sure. If you want to rephrase that, I can think about how I can give you a bit more of an answer on that one. So I think whilst Adnan's thinking about that and we move forward a little bit, let's get going. We've now going to start off and kick things back on again with section 2. Excellent. Developing investment thesis, spearheaded by Andy.
Thank you, Rod, and thank you for guiding everyone through that first section and answering a lot of the questions that were coming through as well. Looking forward now to sharing more. So, Rod, could you share your screen again, and we'll start getting into developing an investment.
I am screen sharing. Can you see it, Andy?
I can.
Is it a guy with the VR headset developing an investment thesis?
I can. I do have you as my main view rather than the sharing. Let me switch to it. There we go. There we go. I've switched. I'm back into it. I hope everyone else can see.
I removed my pen.
Your pen's removed. Can't see your pen now.
Pen, yeah. Okay, cool.
Awesome. I hope everyone else as well can see the main slide. Just mention it in the chat if you can't.
Yeah, okay. We don't want to do that all the time.
Yeah, it is actually. We can see it.
Excellent. All right. And don't forget, you can use the Q&A function. I know a lot of the questions are coming in the chat, but we just don't want to we want to make sure we don't lose any of the questions that people are asking. So
I think I spend half my life
scrolling through chat,
put it in questions and answers. I think they're not going to. You're not going to do it. You're not behaving. So let's keep it. Happy to keep it in the chat if you have to, but ideally, if you put me in the Q&A section, I can see. I've got both these windows open now, so I can do that. But yeah, no, thank you.
Cool. Thank you.
Well, Andy, I'm going to move to the first slide. I've got to control the slide, so Andy's got to tell me to change slides, unfortunately.
Yes, please. So even though this is a cool picture, let's get into this first one. Thank you.
It's a good picture.
Thank you, Ron. So the importance of having a thesis. So I think first we should talk about what a thesis even is, right? So when we talk about an investment thesis, is, you know, if you Google the topic, I think you'll come across a lot of venture capital firms like Y Combinator and USV, Union Street Ventures, and Homebrew, who, you know, have been very public in publishing their investment thesis on their blog. Well, actually, with an angel investor, the thesis is slightly different, and that's what we're going to dive into today. Okay, so why is it helpful to even have a thesis? Right, we touched on a little bit about this in the introduction, but we're going to delve a little bit deeper now. Okay, so the first reason is because it gives you a set of criteria, right? Okay, and And many investors often start off really broad and over time learn where they're going to start narrowing in from, right? Based on what you start learning about yourself, the market, and the startups that you love investing in. And with experience, you're going to learn what you don't want to invest in. And that's such an important thing to just recognize and capture. Like, what don't you like investing in and why, right? It could be, you know, certain hardware businesses because they're capital intensive and you realize that you just don't have the capital and expertise to support these type of businesses. And that's okay, right? So in terms of your investment thesis, kind of get key things to consider before we move on to these core pillars is things such as like, do you have actually an opinion or perspective on the world, right? So there's certain trends that I truly believe in. And I believe in founders who are strong swimmers in strong tides, right? So cryptocurrency isn't a trend that I strongly believe in, for example. So I can't invest in that because I don't even deeply understand it. However, reducing carbon emission, I believe, is a trend that's going to continue to get stronger in the next 10 years. So I'm really interested in looking at startups that are creating, for example, meat-free products or products that help to reduce carbon emission. So you need to decide where your opinions lie. Like, what trends do you believe in playing out in the next 10 years? Because ultimately, you're hoping that those founders that you back are going to be playing out in those markets. You know, the next thing to really consider and think about is the investment amount. Like, how much do you really want to invest? Is it, you know, between, what's the currency, real, 10,000 to 25,000, or is it 50,000 to 100,000, right? The next is really actually what stage, right? We talk about pre-seed. Like someone mentioned in the comments that, you know, do you invest maybe before they even have any commercial value? Do you invest before they have customers? You know, a small portion of angels do, but the majority don't. But where do you decide is that stage that you're going to invest in? You know, we talked a little bit about diversification, and that made me think about geography. Like, you could choose to just invest within your country, but you could gain exposure and investing in the US using platforms like Republic and Angel Fund. You could invest in the UK, leveraging a group such as the UK BAA, right? There's certain sectors and markets that you may have an affinity to, such as fintech and healthcare or consumer, you know, and then we're going to touch later on other things to consider, such as your team, the business model, the product, the IP, and actually what value you can add and whether your background leans to that. Okay, so the three kind of core pillars in terms of the investment thesis are really the competitive advantage, right? So looking back after you map out your skills and your network and the experience that you've had, like, where are your competitive advantages? Where are your peaks, right? The second is around boundaries. Like, actually, what geographies are you going to restrict yourself to investing in, right? So since that experience that I've had, I've never invested in Africa again, but I have invested a lot more in the UK. And I am interested in getting more exposure in the US. What sectors do you choose to invest in? Looking at my portfolio, I actually have a lot of consumer startups that I've invested in, and that's become a sector that I've focused in. Okay, I have a few B2B, also fintech startups that I'm looking at the moment, for example. Then in terms of stage, I like investing at that pre-seed stage, for example. So when they have a little bit of traction, some proof in the market, but still an opportunity for me to really add value and help them along their journey because they're not too late to stage, for example. And then the business model, right? Is it B2C? Is it B2B? Is it B2B2C? And you're going to find that a lot of angel investors have strong opinions about why they stick to a certain business model, right? Like B2B and predictable revenue. And it's a lot easier to understand the ebbs and flows of those businesses. Whereas actually B2C for some investors is seen as too high risk, right? Like, you have to really understand the customer acquisition cost and the lifetime value and keep a handle on that. And sometimes they're too capital intensive in the market, and that's required for those type of businesses. So you need to decide over time actually where your boundaries are going to lie. And then finally, when it comes to execution, it's all about thinking about the deal size, how much you're willing to invest. You know, for now, you're probably going to follow into deals, but at a point, you may choose to lead into deals. So, you know, Rod talked about Chris Abadesh, I always say his surname wrong, and Peter Crowley.
I'll tell him you said that. I'll tell him you said that.
And they often lead on rounds, right? And they're at that level of experience as angel investors where they're comfortable leading on rounds. Whereas actually for new angel investors, it's probably something you're not going to do until you get a few deals under your belt, right? So here are some examples actually of, like the high level investment thesis of some investors. So you see Stefano here on the far left talks about investing in planet positive companies that are focused on alleviating climate change. Then underneath that, he's probably got more detailed filters as to what he invests in and why within that field. Chris, which Rod has already talked about, focuses majority on fintech, but actually has a little bit of exposure and diversification to other markets. I think you mentioned even fish tech, which is a rare one. And then Julie, for example, is one of the alumni from the Angel Investing School, and she focuses on female-led startups, right? So she diversifies widely, but focuses on founding teams that have at least one female founder within their founding team. So you can start to really shape and think about and reflect on what are the things you care about.
Nice comment from Eamon. Let's resume the fun. I like that. Hungry to get back in it. This is probably we've got 2 more sections at the end of for the end of the day. So this section is about how to pick the right business or what to look out for. And then after that, the section is actually about just watching some companies pitch and having a little chat about it, which will be fun. Hi, Andy.
Hello. I've now got a 3-year-old somewhere in the background, so if you do hear a tornado, just be warned, it's just her. She does like to say hello. It's probably best to ignore her for now, or it turns into a whole different conversation.
Yeah, it's like a predator. If you don't look at them or give them your attention, they'll hopefully go away. Like a T-Rex, you're gonna kind of like freeze, don't move, and they might go. I know the feeling. I've managed to lock mine out and put some barbed wire up and everything else. Which is good fun. We've got some questions in here as well, just come in as well. Some of the VC, when they decide to make an investment, they ask for lead investor. So unfortunately, sometimes not angel investor or an angel investor who have a portfolio. Yeah, absolutely. You see a really good point. Sometimes the VCs want to see someone, and it's because, the VC community, they understand what really good angels and experienced angels can bring to the table. Because what is an angel? Often not always, but often they've had other really good business experience, or they've started their own company, grown their own company and exited it and been on that journey in a certain sector. And if that person who has all that experience is putting their own money into something, that's it brings a lot of value to the VC's table as well. So
it talks to what you said about proof points before and lowering the risk, isn't it? It's like if you've gone through angel rounds, you've probably actually got more traction, a little bit more evidence, a little bit more clients in your books. So there's a little bit more data to go on as a VC to take a bigger bet. Exactly.
Yeah, and more. You've raised capital and been able to build and grow your business more without having any other external funding, and see where you're more likely to have grown organically. You've not been able to grow as fast and as hard and made as many mistakes and gained as many proof points, as you say, Andy. So interesting points. So feel free to keep those questions coming. How could an angel investor present himself in a way that he can be accepted? Interesting question. Do you think for one to be a good angel, he needs to have a startup experience? Turkey's question, so I'm going to answer Turkey's question. I don't think necessarily. I think it's always nice to have been through that. But people can add a lot of value in being experienced in their own rights as businesses. Sometimes Absolutely. Some angels may not. They might just have a bit of experience and can be helpful, but not take a leading role. I think this is the interesting thing, is that we make a lot of noise about the lead angels and the big sector experience angels and the big heavy hitters and the famous ones. But the stark reality of an early stage funding round is something like 28, probably I don't know, 60 to 80% of the funding round will come from more passive investors who they might want to open up a network and help them out a little bit where they can and make some introductions, but they're not going to board meetings. Certainly you can't have 20 directors from your shareholders of the board. So they're not getting as deeply involved as well. So I want to kind of raise, you may think that you have to be a legendary exited entrepreneur to invest. You don't have to be. They're the ones that get all the credit and have the brand and make the noise. But it's also about backing businesses and supporting them from behind the scenes as well. Let's be honest.
And it's really important actually, because when you're an armchair investor in the public markets, is literally armchair. There's nothing you can really do. Whereas like when you're an armchair investor in a startup, that money is valuable. Like even if you added no value beyond the money, that money alone gives them the runway, so more months to figure out what their business model is, figure out how they can scale, figure out how to get to market, get more customers. So the money in itself makes much more of a material difference and early stage business than it does in a public stock. So it's really important to just understand at a minimum, the money is so valuable. And in terms of like the whole entrepreneur thing, I have to say, actually, like some of the angels that I've met that are really, really helpful and well recommended are just that, they're helpful. So regardless what corporate they worked in, a lot of them hadn't worked in startups, is the fact that they're responsive, they're available, and they're happy to help on the little things, even if that means just having an ear to listen, hear out a founder, and I can't give you advice, but you know, I've given you maybe another perspective or something to, you know, yeah, it's just a sounding board. So it's honestly the little things that we undervalue are super valuable.
Yeah. And just to answer, Mohammed, your question about how can an angel investor present himself in a way that he can be accepted, I think it comes down to, you know, you don't necessarily, it's about, as Andy says, being approachable. If that's referring to the VC's perspective, it's at the end of the day, the VC, if they think the company's doing really well and hitting great metrics, they're going to want to invest in them, right? I mean, the VCs have actually quite a narrow view of what they want to put their money into. You know, they want to invest often in a certain sector, subsector, and only companies who are really starting to approach the uptick of that fast growth, exponential growth curve, really at the beginning of the hockey stick, that's when they invest. And if the company's in that state, they're going to want to get involved. They might also want to bring other angels and have other angels there as well, but not necessarily as well. Too, but it's an interesting point. So thanks for that. If you want more, feel free to post more depth of a question around that as well, and we can answer that too. So let's kick off and go. I'm just going to have a quick look. I wish we had less breaks. You guys are great and much fun to listen to. Sing that's really nice. I like that. We'll do less breaks then. Everyone, the whole world has groaned at the thought of less breaks as well. Maybe you'll be alone, but let's crack on. We've got about an hour till the next break, give or take a little bit. So let's get going. So what I wanted to jump straight into, and I did actually do that cheeky message, Andy, about it is about the team. It's kind of some of the 3 key things that we're looking for in a startup. So this section, I want you to get across what you should be looking out for and what's really important from an investor's perspective. It's not just about great businesses, it's about businesses with the potential to give great returns. And that is a different business, you know, to something else out there. So 3 key standouts from a company initially to look at, and number one, big standout number one is a great team. I mean, I was about to say I can't highlight that enough, but I am actually going to highlight it an awful lot in the preceding slides and in the next slide, and with some stats around it. But probably about 70% of an investor's decision, your decisions as investors to invest, should be based upon your perception of the quality of the team. It's important, and I want to, and it's for the main reason is a great team can sell a terrible product, but a terrible team could not sell the best product in the world. You know, it's absolutely crucial. And there are a number of things to really look out for. And Andy touched on a little bit about, you know, single founder or multi-founder. That's another factor to look at from a team perspective. But some of the key bits, does the CEO, you know, the founder and CEO, do they inspire confidence? Are they really good at selling to you? Have they convinced you? Because if they're really confident, they've convinced you to invest money, they'll be doing that exact same skillful sales spiel to other investors now and in the future. So you know he's got a better chance of getting the money they need to survive. They'll be doing, if they're really effective and switched on about in that sales and communication process, they're going to be really effective at bringing in customers and pilots and getting things going. So a large part of it, annoyingly, this is where the art bit probably comes in more, is gut instinct. Does this person, do you think, yeah, you know what, they really know their stuff? You know, they're really determined, they've got passion. That's an important factor to look at, because they're going to be going through, and this is what a lot of investors point out, one of the big things to look for is that passion play from founders. Because if they're really passionate about solving a problem or about building something, they're much more likely to stay committed to it and to really drive it and care about it. Because I've mentioned it can take 7-8 years to exit, it can take longer, and you need to have a lot of backbone to get a business to there, or to have a lot of backbone to know you can be CEO up to a certain level, then it's time to step aside for other people to take it forward and move forward. So do they understand their limitations as well? Do they
very hard to do in practice, isn't it?
But very common. It's actually what's very rare is a CEO, a founder CEO, going all the way through to the end and to the exit and to the big names. It's very rare, actually. which is important to remember. It's much more common that they are pushed out at private equity level, or later on level. There's a new CEO to take it into the future. But the team is really important, and how they act and how they behave and the confidence they instill. Another thing to look at.
Just before you move off from the team, actually, I think it's really important to analyze the characters themselves to ensure that they have great relationships between them. Like, how do they react during the bad times? Like, have they overcome adversity together before? Is there any signs of previously working together or resilience in their life stories? Because sometimes actually, like, when teams are fairly new and they're people that haven't got previous history, they're learning about each other for at the same time as starting a business. And that is quite a big risk for you to take, to back them while they're figuring each other out, and some of the things we touched on before about brand, like deep domain expertise or an access to a network. These are all things that differentiate a team as well. It's part of that founding team's brand. Like, one thing that I love seeing is teams that are able to inspire followership from former colleagues. Like, oh, he was so good to work with, I'm going to go work for him again and take the risk and sacrifice this offer from Google to go and work with this founder. Like, that's a positive signal. There's something about him that I need, or her, that I need to pay attention to. So all of these are like really analyzing the character traits to make sure like this is a founding team that we believe in and we want to back. So I know Rod's just touched on team, but honestly, it's such an important thing to mull over and take your time to really think over before making a decision. Like, are they even coachable? Like, if you give them help, are they going to take it on board or always dismiss it because they're so hell-bent on their own ideas and their opinions, So these are the kind of things to really consider.
Another point is, are they actually committed? Are they financially and or emotionally committed? So this is another thing, is we've mentioned about how the going can get tough. And actually, if the founder hasn't put their own money in, or they haven't brought in money from friends or family, that emotional attachment, are they truly committed? They just walk away when it gets too hard and think, you know what, this isn't going to work. Or are they going to fight through, pivot, and build their business back better and make another go at it and have it and turn it around and make things happen? Because a lot of big companies that succeed, they've pivoted a couple of times. LinkedIn, good example. They had a bigger pivot from the start and have done it a couple of times since, and have taken it all the way through to where they are now. So
same as Slack, actually.
Yeah, I mean, it's the same. And actually, what makes a pivot happen? It's the funding. So having adequate funding to buy the time to make that big change and not just die as a result of finding out that's working out. But, a team is really important. There's a few things, Andy says something about, are they coachable? It's, it's a really, really important point, because one thing, there's plenty of founders out there who think, they're the best thing since sliced bread. They're amazing in everything they do, but they won't learn. You have to be able to learn and adapt to a situation. Really, really important. Some of the things that some of our investors do are to try and help with that kind of due diligence process. And I am going to cover it, tomorrow. But one of the things they do is they ask them a question, a really hard-nosed question that they know for a fact that the founder does not know the answer to. And she's more interested, when she asks them this, she's much more interested in the way they respond, not what they respond with. Do they blag it? Do they outright lie? Do they try and avoid it? Or what she's looking for, do they go head on and say, you know what, I don't know the answer to that. And actually, we're unlikely to be able to understand how much of that will become a risk factor for another year or two, but we're certainly looking into it. It's about being able to be open, to be adaptable, to know your weaknesses, and to be just a good operator, really, what it comes down to. So it's really
I think another thing as well, I know we're laboring on this great team, but like, how did they treat people? Like, are they treating their own people well? Because the number one asset in your company is your people. They're the ones that are creating the value. They're the ones that are building technology. They're the ones that are selling it. They're the ones that are supporting customers. So it's really important that they're able to treat people well. And I've seen this question actually from Mohammed, who says, if the CEO presents like a three-year growth plan and asks friendly,
3 different growth plans,
like asks the investor what they recommend they go for, and even in that question, I think that tells you about the CEO, about the founder. Like, it's different if the founder presents like, these are 3 different levers we're thinking about pulling. These are 3 different growth strategies that we're experimenting with. These are 3 things that we're considering and slowly testing with the market. And when we get some evidence, we're gonna deep dive into one, like, what are you thinking about these experiments? That is a better qualifying answer to show me how you think, rather than you're looking for me to basically tell you how to run your company. You know, and that's not what we want. That's not the coaching we're talking about. The coaching we're talking about is we're running 3 different experiments. Like, these are the things that we're considering. Is there any holes that you see in these plans? Like, that's a better question for feedback rather than for answer.
Yeah, no, absolutely. No, totally back that. The next thing to look out for is it truly scalable? Is the business actually, can it scale hard and fast? You've got to remember that I showed you the returns about how 90%, 80%, 90% of your returns come from just 10% of your portfolio, and they're doing it by doing this 10x return, this 100x, you know, this big, strong return. And to achieve that, that company has to swell by a magnitude of 10, if not more so, because of dilution over a 5, 6, 7, 8 year period. And that means they've got to be able to scale and grow and build something that's amazing. Can they actually scale? I mean, this is why digital businesses and digital tech has done really well from an investment perspective and from returns perspective, is because it's so easy to scale that company. You just need to buy more server space at AWS to expand out the offering, with more people who come in to buy your SaaS. B2B SaaS has done incredibly well. Is it a big market, and can they scale and grow it? We're seeing a new really interesting dropship models and things where previously, if you want to sell a product, you had to be able to scale, build your warehouse, build your manufacturing facility and everything else. But now you can actually scale and shift product by actually not having ever even touching something to sell it. You can just go straight to consumer, and you're just selling as a market front. So it's important to look out for something that can truly scale and doesn't need a huge amount of capital funding and infrastructure to actually make it work. And I think, Andy, you mentioned that in a previous slides around avoiding certain sectors that require huge amounts of capital expenditure. So scalability is really important, and that's why digital technology has been attracting the lion's share of investment, I'd say.
Yeah, and even I had a message today on LinkedIn, not from one of you added me, but from someone else. You talked about how they just came back from Ghana, and they've got a $1 million idea, and they want to buy some land in Ghana. Do I know any investors? That isn't the type of investors we're talking about. We're talking about tech investors here who want to scale technology, not people, not land and resources like property, to build a business, right? And sometimes we get into murky waters. Like, if you think about businesses such as WeWork, there are so many arguments to say that it's such a capital intensive business. It's more of a property business than a tech business. Why is the valuation like a tech business? Or certain lending companies, even in the UK, we had one called Funding Club. Oh, that's more of a financial services business. That's not a tech business. They're hiring people rather than tech to leverage, to scale and grow. So there's sometimes a bit of blurred lines, and that's where you need to really lean on your investment thesis and understanding what you do and you don't invest in, because you're going to meet that at some point. You're going to meet some businesses that, you know, position and value themselves as tech, but you need to ask yourself, are they truly scalable?
So the next bit to then, it kind of ties into that, is do they have a strong market fit? It's that key product market fit. Have they got enough of, is their product or service or offering, is it solving a really painful and expensive problem? That's what it comes down to. What's the problem, and how expensive and painful is that problem? And how cheaply or more effectively can you solve this problem with your product or service? That's what it comes down to. And what you want to look out for is something that has that strong product market fit. So the market and industry is almost, it's industry pull, market pull, rather than someone inventing a product that doesn't actually exist anywhere else out there. No one knows about it, and trying to shovel it at people who don't understand what they need for it. This is what you want to see, is a business that genuinely is solving a big problem that a lot of people would like to see solved. Thank you very much. And that's why technology obviously is becoming really interesting, because that's exactly what it's there to do. It's to solve problems quicker, cheaper, and faster. But is it also solving that problem better than the competition by an order of magnitude? I mean, we see businesses who have only a small, tiny little increase on improvement. Oh, we can do the same as this big competitor, but we do it for 20 reals cheaper. If it's not a massive shift and a major change, it's not worthwhile, because they've got a lot of work cut out to convince customers to change their buying habits, to buy their product over what they've been doing. You know, the biggest, even, you know, founders you'll often hear it, I've got no competition. It's like, well, nonsense. You'll have competition you wouldn't know about. But actually the biggest piece of competition is inertia. People just can't be bothered to have to try and change for your, you know, marginally better software product or service. You know, if it's only a little bit better, I'll just stick with where I am. Thank you very much. You can't be bothered. It's a lot of work to do that. So it has to show something that's really exciting, much bigger, an order of magnitude bigger, faster, better, cheaper, whatever it is in the product or the service, but something that's really there and solving that key point. And that's something that you want to find from an investor perspective. And the proof points around that market fit is commercial traction. I'm going to cover that in a little bit about what to look for around there, because that proves that market demand and interest. So this is the bit I said. Oh, there's some questions in the Q&A. Let's have a quick look in the Q&A section. I can't find the window for it. Here it is. Is there a database that shows different metrics in different industries? For example, customer acquisition cost, burn rate, churn, benchmarks in fintech? Probably. I don't actually know of anyone. And I don't know if you know of any, but there probably are actually.
Yeah, so there's high-level database for startups such as Crunchbase and Deal Room. In the UK, we've got one called Tech Nations Datacoms, but they're really high level. So they share with you, I guess, the funding rounds, the type of startups in different sectors, and who attracted what funding. But to find that detailed data on things like customer acquisition cost, lifetime value, will be very difficult. But I think if you go on websites like Product Hunt, there's always little tools that are released to show that kind of data. But even if you find it, I think it'll be a small database, because a lot of startups are going to hold on to that.
Firms will have their own little databases and
yeah, exactly.
Down on, they'll look at the metrics and see. This is one of the things that they'll do is they'll think, well, this is a really interesting problem that's out there. There's a few startups and scale-ups that are kind of solving this problem. They'll have meetings with them all and get as much data as they can. They'll stick it into the spreadsheet and see, well, which one's tracking the best? That's where we're going to put our money, and hedging their bets. You know, it's pretty, you know, there's not a lot of, you know, magic and amazing skill often in some aspects of VC investing. It's all about going into a bullish market that's going to grow anyway, getting in, chucking yourself right in there, meeting all the startup founders that are doing something in that space, getting to know enough about them to know which one's doing the best, has the best chance of smashing it, and then putting your money into that one. Maybe the second best as well, just to be on the safe side, because I might get a secondary exit. You know, it's interesting. But yeah, no,